Did you know that even a 1% increase in lending rates can add thousands of dollars in interest to a typical mortgage? With the upcoming lending rate report just around the corner, what do you think it will reveal and how will it impact your finances? Welcome back to the channel. Today, we're diving into a topic that affects every one of us, the upcoming lending rate report. Whether you're a homeowner, business owner, or simply someone looking to borrow money, lending rates have a direct impact on your financial well-being. The decisions made in these reports can either save or cost you thousands of dollars over time. In this video, we'll explain why this upcoming report is so crucial and what it could mean for both individuals and businesses in today's financial landscape. Let's start with the problem. Fluctuating lending rates create uncertainty for both consumers and businesses. When rates rise, it becomes more expensive to borrow money, whether that's for buying a house, financing a car, or expanding a business. Higher rates can also slow down consumer spending and investment, making it harder for businesses to grow. For consumers, higher borrowing costs lead to larger monthly payments and can delay major purchases. For businesses, it means higher costs for loans, which can reduce profitability or even stall expansion plans. On the flip side, lower lending rates can spur economic growth by making it cheaper to borrow. But with inflation concerns on the rise and central banks making adjustments, predicting where lending rates will go next is becoming more challenging, and that's why the upcoming report is so important. It's going to provide insights into the direction of lending rates, and understanding what's at stake can help you prepare. Now let's explore the factors influencing lending rates. There are several economic indicators that central banks use to determine whether to raise or lower rates. One of the most important is inflation. When inflation is high, central banks often raise rates to slow down the economy and curb rising prices. On the other hand, if inflation is low and the economy is sluggish, central banks might lower rates to encourage borrowing and spending. Another major factor is employment data. If unemployment is low and wages are rising, central banks might decide that the economy is strong enough to handle higher rates. However, if unemployment is rising, they may be more inclined to keep rates low to stimulate growth. Economic growth also plays a role. When GDP growth is strong, central banks may raise rates to prevent the economy from overheating. But if growth is weak, they may opt to lower rates to encourage investment and spending. The policies of central banks, especially the Federal Reserve in the US, are crucial. The Fed controls the base interest rate, which in turn affects lending rates for banks, businesses, and consumers. Their decisions are guided by all of these factors, but also by global economic trends, geopolitical risks, and financial market stability. As the date for the upcoming report approaches, experts are closely analyzing these indicators. Inflation has been a hot topic throughout the year, and many economists are predicting that we could see a rate hike in response. However, with recession fears looming, there's also speculation that central banks might take a more cautious approach. So, what does that mean for you? Here's where things get interesting. Many experts are predicting that the upcoming lending rate report will either signal a slight increase in rates or a steady hold, depending on inflation data and global economic pressures. If the report reveals higher rates, consumers can expect more expensive mortgages, personal loans, and business financing. On the other hand, if rates remain low, there's a potential boost for those looking to borrow before rates inevitably rise. For businesses, this report could signal whether it's time to lock in financing now or wait for better conditions. A rate increase means higher costs on existing loans and new debt, while steady or lower rates could be a green light for expansion. For homeowners and future home buyers, the implications are significant. Rising rates could push monthly mortgage payments higher, especially for those with variable rate loans. Fixed-rate mortgages might become more attractive, as locking in a rate now could save thousands over the long term. So, To recap, the upcoming lending rate report is going to have a major impact on both personal and business finances. Higher lending rates mean higher borrowing costs, which can slow spending and investment, while lower rates can encourage growth but may lead to inflationary pressure. We've discussed how inflation, employment, and central bank policies all influence these decisions, and the importance of staying informed about these trends. Whether you're a consumer planning a big purchase or a business owner looking to expand, understanding these lending rate changes will help you make smarter financial decisions. The key takeaway: stay alert, plan ahead, and consider how this report will affect your future. Now it's your turn. What are your thoughts on the upcoming lending rate report? Do you think rates will go up, down, or stay the same? Leave your thoughts in the comments below. And if you're interested in learning more about how to navigate changes in the financial landscape, make sure to check out my other videos on personal finance and economic trends. Don't forget to like, subscribe, and hit the notification bell so you never miss an update. Thanks for watching, and I'll see you in the next video.